Investors often ask, "What do you think of this company?" or "Is this stock worth buying?" Sometimes the most honest answer is, "I haven't researched it." Other times it is, "I have researched it, but I still don't understand the business well enough." The first answer is easy to accept. There are thousands of publicly traded companies in the United States, and new ones come to market every year. Most individual investors will research only a small fraction of them in real depth. If I haven't done the work, I don't have a reliable opinion to offer. Looking at a stock chart, checking a few valuation ratios, and reading the latest headlines does not amount to understanding the business. The second answer is more easily misunderstood. Most of the raw material is publicly available. Investors can read annual reports, earnings call transcripts, investor presentations, product materials, and industry research. With enough time, I can usually learn what the company does, where its revenue comes from, and what the market expects from it. But I may still be unable to explain why the company earns attractive profits today, and what will allow those profits to endure. Until I can answer that, the company remains outside my circle of competence. I tend to think of active investing in terms of two classic approaches. One is the cigar butt approach associated with Benjamin Graham and Walter Schloss. These investors looked for companies trading far below their net current asset value or book value. They bought a diversified group of them and waited for the gap between market price and asset value to close. The business itself might be mediocre. It might even have serious problems. But when the price is low enough, an investor may still profit from the discount to the underlying assets. Buffett once compared this approach to finding discarded cigar butts on the street. They may look dirty and unpleasant, but one of them might still have one last puff left. You pick it up, take that final puff, throw it away, and start looking for the next one. The method works. Walter Schloss used it successfully for decades. But it requires investors to keep hunting for new bargains, monitor market prices closely, and spend a great deal of time owning low-return, low-quality businesses. I don't enjoy that style of investing. I don't want to spend my life hunting for one cigar butt after another, or holding businesses I don't respect simply because they are cheap. Studying and following a good business is far more enjoyable. Once I understand it well, the ongoing work is often limited. I can focus on a small number of important variables and keep asking whether the original business logic still holds. The other approach is the one Buffett and Munger eventually embraced: owning exceptional businesses. They looked for companies capable of earning high returns on capital and compounding their intrinsic value over long periods. They tried to buy those businesses at sensible prices and let time and business performance do most of the work. Buffett has often said that time is the friend of a good business and the enemy of a bad one. A low-return business may look cheap when it is purchased, but weak economics will continue to drag on the investor's results. An exceptional business can keep generating profits, reinvest those profits at attractive rates, and allow time to magnify its value. That is the path I prefer. I start with companies that have already proved they can make money and appear likely to keep doing so. Why exclude businesses that are not profitable? A simple identity helps explain the reason. Market capitalization equals net income multiplied by the price-to-earnings ratio. When earnings grow over time, long-term shareholder returns can come from the business itself. When earnings do not grow, returns become much more dependent on multiple expansion. Someone in the future must be willing to pay a higher price for the same level of earnings. That means predicting changes in the emotions of thousands, sometimes millions of market participants. I don't believe I can do that consistently. I would rather focus on value created by the business itself. Some companies lose money today and later become enormously profitable. A few will become great businesses. I am happy to leave those opportunities to venture capitalists and investors who specialize in early-stage growth companies. An investor does not need to capture every opportunity the market offers. I prefer to search for future winners among companies that already have a proven record of profitability. This approach does not guarantee success, but it narrows the field considerably. Unprofitable companies are only one group I exclude. I also avoid companies whose earnings are difficult to trust. Receivables may grow much faster than revenue. Reported profits may repeatedly fail to convert into cash. Earnings may depend heavily on asset sales, fair value gains, or other one-off items. When these issues appear, I need a convincing explanation. If I cannot find one, I move on. Individual investors do not need to solve every accounting mystery. Their time is usually better spent on businesses that are easier to understand and more worthy of deeper research. After this initial screening, I may find a company with a long record of profitability, strong cash conversion, and no obvious concerns in its financial statements. Does that mean I understand the business? Not yet. It only tells me that the company has made real money in the past. I still need to understand the business model and the competitive advantages behind those profits. In plain language, I need to answer 3 questions. What products or services does the company sell, and where do its profits come from? Why do customers choose this company over its competitors? If the profits are so attractive, why haven't competitors offered better value, taken market share, or forced margins down? Better value may mean offering the same quality at a lower price, or better quality at the same price. These 3 questions all point to the same issue: what keeps competitors at bay? That protection is what investors call a moat. A moat can come from a superior product, a trusted brand, a cost advantage, patents, switching costs, network effects, distribution advantages, regulation, scarce resources, or operating capabilities built over many years. At least one of those advantages must be expensive, time-consuming, or nearly impossible for competitors to replicate. Even then, the work is not finished. A moat that protected the business in the past can still be filled, bridged, or bypassed by new technology, new distribution channels, or a different business model. So I ask a 4th question. If a well-funded competitor, or a powerful company from another industry, entered the market aggressively, could this company defend or even expand its market share? Buffett has said that he prefers businesses with simple, understandable economics. Microsoft was already an exceptional company, and Bill Gates was one of the most impressive business minds Buffett had ever met. But Buffett could not confidently predict what the technology landscape would look like 10 years later, or how Microsoft's competitive position might change. So he passed. He felt differently about chewing gum. However much the internet changed the world, people were unlikely to stop chewing gum. Even if someone gave him $1 billion to challenge Wrigley, he did not know how he could dislodge the consumer loyalty the company had built over decades. The same logic applied to Coca-Cola. Even with $10 billion, Buffett did not believe he could seriously damage its global business. Capital can buy factories, equipment, advertising, and talent. It cannot quickly buy decades of brand recognition, consumer habits, distribution reach, and operating know-how. Buffett's thought experiment is simple. If I had enormous resources, could I seriously hurt this business? If the answer is still no, the company may have a very wide moat. If capital, technology, or a new business model can cross that moat easily, past profits tell us little about future profits. That is why simpler businesses are often easier to understand with enough confidence to invest. An investor does not need a precise earnings forecast for every future year. Nor does an investor need to know exactly when the market will recognize the company's value. The key is to understand what the business is likely to look like years from now, and whether the foundations of its earning power will still be intact. If that long-term direction is clear, the exact quarter or year matters far less. Once I can answer these 4 questions, I can reasonably say that I understand the business. Only then does it make sense to estimate what the company may be worth, and what price would justify buying a stake. If I don't understand the business, even the most elaborate valuation model becomes little more than false precision, a way to reassure myself without truly knowing what I own.